Mastering money management is a vital skill that everyone should learn, and it's never too early to start. As a teenager, you might be earning your own money through allowances or part-time jobs, which makes it the perfect time to learn about budgeting. In this video, we'll walk you through the process of creating your first budget, tracking your spending, and setting financial goals. By following these steps, you'll gain control over your finances and set yourself up for a secure financial future. Step 1. Figure out how much you make. At its core, a budget boils down to a simple equation: income minus expenses. However, in practice, both expenses and income can fluctuate from month to month. Therefore, it's crucial to have a clear understanding of your average monthly income after taxes. While occasional windfalls like birthday or holiday money may be exciting, it's essential not to rely on them as regular sources of income. By focusing on your consistent earnings, you'll build a more reliable foundation for your budgeting efforts. Step 2. Keep a record of your expenses. Understanding your spending patterns is key to creating an effective budget. While you likely have a good grasp of your income, pinpointing where exactly your money goes can be a bit trickier. You might be surprised by how much you're spending in certain areas. To gain insight into your spending habits, start by collecting data. Keep track of every expense, whether it's through saving receipts or logging each transaction for at least a week, ideally for an entire month. This diligent record-keeping will provide valuable insights into your spending behavior and serve as a solid foundation for crafting your budget. Utilizing a worksheet or sample budget can also streamline this process and make it more manageable. With a clear understanding of your income and expenses, you'll be well-equipped to take the next steps toward creating a comprehensive budget tailored to your financial goals and priorities. Step 3. Identify where you're spending. Looking at what you need to spend versus what you want to spend will tell you how much you can save and where you can eliminate spending. Necessities might include money for transportation, whether that's gas money or bus fare, school supplies, your phone bill or data plan, etc. Spending on takeout and entertainment like movies, concerts, or games would count as discretionary spending. It's also a good idea to categorize your discretionary spending. For instance, you may notice that you put a lot of your money into a particular hobby or into spending on food and drinks when you're out with friends or on clothes. Separating these expenses into their own categories within your discretionary expenses will make it easier to track your spending and help you create micro-budgets within your master budget. Step 4. Subtract the total spent on necessities from your earnings. Now it's time to do a little arithmetic. Add together the amount that you're spending necessities each week or month and subtract it from the income you got on Step 1. This will give you the amount you have to spend on fun and put into savings. Next, subtract what you've been spending on non-necessities. Then see how much you have left over for saving at the end of the week or month. To budget effectively, you must spend less than you earn. If you have nothing left over or are spending more than you're making, gasp. It's time to go back to your discretionary funding and find ways to save, whether that means bringing food from home sometimes or finding ways to have fun without buying stuff. You may also find it's easier to keep from spending if you have a daily or weekly spending limit for yourself, rather than a monthly one. Step 5. Create savings goals. In life, one constant is the unpredictability of the future. To prepare for unforeseen circumstances, it's essential to start saving money as a teenager. Saving doesn't have to be mundane. It can be a creative and empowering endeavor. Beyond setting aside funds for emergencies, now is the perfect time to consider other upcoming expenses. Whether it's saving for significant milestones like your first apartment or smaller indulgences like a new pair of shoes or concert tickets, having specific savings goals in mind is crucial. Moreover, you can and should simultaneously save for multiple goals. Leveraging tools like Copper can simplify the process, offering features such as separate savings, buckets, and goal tracking functionalities to keep you organized and motivated. By proactively saving for both the expected and unexpected expenses, you'll build a financial safety net and pave the way for a more secure and fulfilling future. Step 6. Decide how and how much you want to save each budget cycle. When determining how much and in what manner to save during each budget cycle, various methods offer structure and flexibility to suit individual financial goals and preferences. One popular approach is the 50/30/20 rule, where 50% of earnings cover needs, 30% address non-essentials, and 20% is allocated for savings. Flexibility exists within this framework, allowing adjustments based on personal circumstances. Alternatively, the pay-yourself-first strategy, also known as reverse budgeting, emphasizes prioritizing savings by allocating a predetermined portion of income directly into savings upon receipt, followed by budgeting for necessities and discretionary spending. Zero-based budgeting appeals to those seeking meticulous organization, requiring every earned cent to be allocated towards various budget categories, ensuring that income minus savings, expenses, and discretionary spending equals zero by the end of each cycle. Envelope budgeting offers a tactile or virtual approach, where cash or virtual envelopes are used to assign specific amounts for different expenses, ranging from necessities to savings goals and leisure activities. Each method provides a structured framework for saving, with the flexibility to adapt to individual financial circumstances and priorities. Step 7. Start using your budget and stick to it. This step is crucial for the success of your budgeting journey. Remember, a budget only works if you stick to it consistently. While it might be tempting to splurge one week and promise to catch up the next, this approach is often challenging to maintain. It's far easier to stay on track by adhering to your spending and savings goals from the start. By doing so, you'll establish healthy financial habits and accelerate your progress toward achieving your desired financial milestones. Embrace the discipline of adhering to your budget, and you'll soon reap the rewards of your financial diligence. Step 8. Check in and reevaluate if needed. After a month or two of using your budget, take some time to evaluate your progress and assess how well the budget is working for you. Are you consistently overspending in certain categories, such as entertainment or dining out? Are you successfully allocating leftover funds into your savings account? And are you on track to reach your financial goals? Remember, it's okay to adjust your budget as necessary to better align with your spending habits and financial objectives. By regularly reviewing and tweaking your budget, you'll ensure its effectiveness and enhance your likelihood of long-term success in managing your finances. Creating your first budget may seem daunting at first, but with the right approach, it can be a fun and empowering experience. By understanding your income, identifying your expenses, creating a budget, tracking your spending, and setting financial goals, you'll gain control over your finances and set yourself up for a secure financial future. So take the first step today and start mastering money management. It's a skill that will benefit you for life. Thank you for watching. Don't forget to like and subscribe to our channel for more content like this.